So in the next video, we discuss equity investments. Up till now, we've talked about investments where the company owns roughly less than 20% of the equity in the investment, meaning it has no real influence over the activities of the firm or no significant influence over the activities of the investment. Well, what happens when you own 25 or 30% or 40% of another business? You don't have control, but you certainly have significant influence. And the threshold for that is roughly 20 to 50%. In other words, the threshold for using the accounting approach that reflects significant influence, the rough rule of thumb is if you own 20 to 50% of a company, usually the equity method is what's going to be applicable in terms of how you account for that investment. Under the equity method, when a company invests in another business, the investment is initially measured at acquisition price and recorded as an asset titled equity investment in affiliates. In terms of the mechanics of that, it's identical to what we've talked about up till now. Cash goes down and an investment asset is created. It's just a long-term asset instead of being a short-term asset. And so here we walk through a very simple example of that. So imagine that on the investment date, January 1st, 2015, we acquire a business that has a book value of $400 million and we acquire it for $100 million and we acquire 25% of it. So we acquire 25% of a $400 million book value business for $100 million. Obviously, in this very simple exercise, we're assuming that the investor pays no premium above book value. We're going to relax that assumption shortly. So the question is, what is the impact on the balance sheet of the investor? Now that we own now that we're taking a 25% ownership in this business, let's walk through the journal entries for that. So cash goes down by 100. It cost us $100 to buy this business. And it's fairly straightforward. The offsetting debit is the creation of an investment asset. So that's really it. So we see cash going down to $1,100, and we see investment in affiliates going up by $100. And there's really no other change. Everything else effectively stays the same. No real difference from how we've accounted for short-term investments. But now let's look at what ends up happening during the year. And this is where it becomes really different from how short-term investments are accounted for. So when the affiliate reports income, and we're calling it an affiliate as opposed to an investment, just to kind of also to keep consistent with the nomenclature for this accounting method, we consider the investment the affiliate. When the affiliate reports income, the investor's proportion of the affiliate's net income is reflected as a line on the investor's income statement. So this is where there's a real difference. Recall how in the prior example that we just went through, in fact, let me go back. One of the things that we specifically address is when you're identifying line items as trading securities or as available for sale securities, we actually don't care. If we own like 0.0004% of Walmart, we don't care what Walmart's net income was. All we care about is the stock price appreciation that we recognize as unrealized gains on the income statement. Well, that changes once we look at equity investments. When we look at equity investments, the opposite is true. When the affiliate reports the income, the investor's proportion of the affiliate's net income is reflected as a line on the investor's income statement. And what we see on the investor's income statement is they have revenues, expenses, pre-tax income, taxes, etc. But in addition to just the investor's income statement, we also have to account for our proportionate share of the affiliate income. And if the affiliate has generated $150 million in after-tax income, our proportionate share of that net income is 25% of that. So 25% of 150 is 37.5. So we're going to do 25% of 150. So that's going to equal 37.5. And so the total net income for the investor is now 297.5. And understand that is a very different conceptual framework than the one we use for investment securities. We are now looking inside the income statement of our affiliate. We're looking inside the income statement of our affiliate and taking the proportion of that income statement that belongs to us. And that's what we're recognizing on the income statement, as opposed to recognizing dividends, as opposed to recognizing any sort of cash payments. See, this is accrual accounting. Once we recognize that we have some sort of, once under US GAAP you recognize, or IFRS, you recognize that you have significant influence over a business, how much cash comes in the form of dividends is now not as important for the purposes of constructing your income statement as what is the accrual-based income that belongs to you. And that's the fundamental difference. When you had no influence, the accrual concept actually went by the wayside. It was just under US GAAP and IFRS, you are allowed to just say, you know what, I'm going to reflect just share price appreciation and whatever dividends I receive because I'm such a passive investor in this entity. But once you have influence, it's accrual accounting again.